Hello, I think we can get started already because we have most people here. Team one, would you like to get started?
Okay, I'll share screen. Can you see my screen now?
Yeah, we can see your screen.
Okay, so this month we pivoted to looking at tech stocks in the US, and one of them is Spotify. We're looking at a target price of 112 with a 7.5% upside, which is a bit lower than what we're looking for, to be honest. Okay, but for an overview of Spotify, it's an audio streaming platform that has gained popularity worldwide, and it monetizes its services through subscriptions and advertisements. So, as a user, you can avail the free subscription with ads or the premium subscription without ads. It has 433 million monthly active users. 188 million of these are premium subscribers. And North America is its biggest market with 32% of monthly active users, but it has a presence in 183 countries overall. At the moment, they offer music, podcasts, and live stream services, while the co-founders of Spotify own a 26.8 stake in the company. So there's still room for other shareholders to influence voting at AGMs. And their revenue model can be broken down into the ad-supported subscription and the premium subscription. So the first one is a source of ad revenue and serves as the top of the funnel, driving a significant portion of total gross added premium subscribers. It helps the company achieve attractive unit economics as they scale up. And for the premium subscription, users can access unlimited high-quality streaming without ads. And there are a few plans that are adapted to each local market, which generates recurring revenue for the business. Revenue has been rising at a CAGR of 22.5%, though top-line growth slowed in 2020, which was the COVID year, as consumers in key markets eased consumption, especially in Latin America. But growth picked up immediately in 2021 as premium subscriptions surged, led by Europe and Latin America again. So premium subscriptions have been the main driver of top-line growth, and they make up 87.5% of FY21 revenue. So focusing on premium subscriptions, it grew at a CAGR of 23.3% from FY18 to 21, mostly led by the family and dual plans. But overall growth slowed as penetration into mature markets decelerated. And monthly ARPU for premium subscriptions have been decreasing as well. In FY18, it was attributed to the growth of the family plan, where up to 6 accounts can share the plan. So if this is maxed out, the ARPU goes down. While in FY20, it's attributed to a change in the premium subscription mix.
So next, I'll be sharing about the industry overview for the music streaming service. So currently, Spotify is the most dominant player in the market with a 34% market share, followed by Apple Music with 15% and YouTube Music with 8%. And as you can tell from the graph at the right side, the US music streaming market is expected to grow at a CAGR of 13.3% in the next 8 years. It is able to maintain such a high growth primarily because the music streaming market is still absorbing revenue from the physical music album market. Currently, the music streaming service only takes up about 60% of the entire music industry. So next slide, please. So next I'll be analyzing the industry from the Porter's 5 forces. So firstly, the bargaining power of consumers is moderate to us. Although that customers can always switch from one app to another, but it is unlikely that they will change because they need to set up the entire music playlist from scratch. Also because they won't be able to share music with their friends on the platform anymore. And secondly, for the intensity of competitive rivalry, we already know that the industry is saturated with players, and definitely there's going to be more competition among the top 3 players in the market. And as for the bargaining power of the suppliers, we think that it's pretty high because the music industry is primarily controlled by the 3 main record labels, including Sony, UMG, and Warner. So if Spotify loses any of the 3, it will lose a large chunk of the content library. But this is less worrying for Spotify because UMG and Sony are both shareholders of Spotify. So it's unlikely that they will terminate their agreement. And good news is that the threat of substitution is pretty low as Spotify enjoys a first mover advantage. And also the barriers to entry is pretty high as the incumbent players have large cash war chests and thus deterring new players from entering the market. And it is also difficult to obtain music licenses from all 3 record labels and indie musicians to build a large enough content library to compete. Next.
Yeah, so our first thesis is that Spotify has a strong competitive moat where there's high stickiness due to entrenched user habits. So Spotify, similar to the various successful social media platforms, has its own algorithm that recommends the latest music that's tailored to listeners' preferences, be it podcasts, music, and audiobooks. So users are essentially hesitant to switch audio streaming platforms as they would have to familiarize with a new algorithm and recreate their playlist. So Spotify premium subscriber churn has reduced from 5.5% in 2017 to 3.9% in 2021. There have also been strong reductions in churn in Spotify's mature markets, dropping to as low as 1 to 2%. Next. We also expect Spotify's podcast and audiobook acquisitions to drive growth. So Spotify has been branching out of the music space and rapidly been acquiring podcast, audiobook, and live audio firms in a bid to differentiate itself. So music is a largely commoditized product, and so by building and acquiring intellectual property, Spotify is aiming to separate itself from the other incumbents. So next. So the podcast and audiobook markets represent an untapped growth opportunity since the users listen to podcasts on Spotify spend more time on podcasts than music. So given that the podcast is a type of long form content and has an average revenue per user 4 times than that of music only campaigns, Spotify can expect its podcast margins to top 30% and eventually settle between 40 to 50%. So also with that, the increasing market of audiobooks with about 50% of the 140 billion global size of the book market, representing an annual opportunity of 7 billion. So Spotify's increased efforts to onboard more audiobooks will definitely serve as a major growth driver in time to come. Next.
Moving on to our third thesis, we like that Spotify has been doubling down on its existing growth segments. So for example, for its two-sided marketplace, where it makes money from selling marketing tools to labels, it saw a triple-digit year-on-year growth in 2Q22. Moreover, in its podcast segment, it has expanded into video podcasts. And this is great because it gives Spotify the opportunity to launch video advertisements for the first time. And as we know that videos tend to attract more ad dollars, thus leading to potentially higher ARPU. Yeah, next. Now moving on to our valuation. We use a DCF Gordon growth method as our primary valuation method, which yielded upside of 6.6%. And we supported this using the exit multiple DCF valuation, which gave an upside of 8.3%. And thus, this gives a blended upside of about 7.5%. Next. And lastly, moving on to our risks. The first risk that we want to highlight is high concentration risk. So 78% of Spotify music streams in 2021 were licensed from just 3 record labels. However, we note that these license agreements can historically have had a multi-year duration. In addition, Sony Music, which is one of these 3 labels, has a 2.7% stake in Spotify and is thus incentivized to continue its partnership. Secondly, we looked at the poor macroeconomic outlook. So during this recessionary environment, premium users may choose to unsubscribe. Moreover, advertisers could also be less willing to spend on advertisements, potentially dragging down ad-supported ARPU. However, in spite of these dire macro conditions, Spotify's CEO actually came out to state that it still expects to beat its initial projections for FY22 subscribers and users. And it is also slowing hiring by 25% in the second half of this year. And this shows that the company is being prudent with its budget. And lastly, we note that there's been increased data regulation across the entire advertising space. And this may affect advertisers' ability to effectively target ads, and thus potentially leading to a decline in ad-supported ARPU as well. And however, we note that this is an industry-wide change, and Spotify is not the only one who is being affected. And the company has actually weathered this well, as 2Q ad revenue jumped 17% year on year. And overall, we believe that the long-term digital advertising trend still remains intact. To sum up, we believe that Spotify has a strong competitive advantage, and its podcast and audiobook acquisitions continue to serve it well for its future growth expansion. However, we note that this current valuation is limited, and thus we are just adding Spotify to our watch list instead of initiating a position at the current moment. However, as we have looked into US tech stocks, we came across Google and believe that it is a potential initiation that we want to make in our portfolio. So our thesis is that Google has become a verb. We all use Google as a verb, so like Google this and Google that. So and this has led to increased mindshare. And Google has a strong ad business, and its revenue is expected to continue to grow at a 12% CAGR over the next 3 years. And this is in comparison against its competitors like Meta, which saw a 14% lower price per ad in Q2 this year. And thus, we believe that Google fits into the strong compounder category. Moreover, we looked at its valuation and we believe it is undemanding. So Google is currently trading at 11 times next 12-month EV/EBITDA multiple. And this is just slightly above the 9.5 times EV/EBITDA multiple that we saw during the 2020 COVID crash. And revenues continue to expect to grow in the mid-teens in the next 3 years. And if we assume a 2026 EV to FCF multiple of 25 times, the target price will be somewhere around $220 per share. So we just use a very quick and dirty DCF calculation. And this would represent almost a 2x from the current price, or representing about a 19.7% yearly annual return over the next 4 years. Yeah, and thus we are continuing to dig into Google and may potentially make it our first initiation of our portfolio. Yeah, thank you so much.
Thank you so much. Does anyone have any questions for this team? Okay, if no one has any questions, then maybe we could move on to the next team. Any ESG consideration for Spotify?
Yeah, hi Shinya. For Spotify's ESG, we didn't really delve too deep into it, but what we noticed is that there's no like big ESG red flags. Yeah, so that is about it for the ESG segment for now.
Okay, maybe we can move on to the next team then.
Okay, sure. Wait, let me try to share my screen. So can my screen be seen?
Yeah, we can see your screen.
Okay, thanks. So this is Team Alice's portfolio update. So our current position is still with Meta, and it's currently at approximately 5.91% loss. Yeah, because the current share price today is like 160. So for update, yeah. So for updates wise, actually yesterday Meta, it was just announced that Meta signed a multi-year agreement to team up with Qualcomm's Snapdragon XR chips for their next headset. Yeah, and basically who is Qualcomm, in case it's a very unfamiliar company, is that they're actually an MNC known for designing and manufacturing semiconductors and wireless telecommunication products. Yeah, and then they have these three main business units, which is for their technologies, their technology licensing, and their strategic initiatives. And they primarily compete with companies like Huawei, Nokia, Samsung in mobile tech, and Samsung in the semiconductor market. So their portfolio also includes products for processors, modems, platforms, and essentially all these products that are based on end use applications. So essentially what the Qualcomm deal shows is that for Meta's upcoming headsets, they are actually trying to have a more premium headset, which is called Cambria, versus their current more, not really low end, but their current more mid-tier headsets, which is like the Quest. And to be very frank, these Cambrias will be sold at a premium. So I think our team is kind of unsure how feasible this will be, considering the fact that the revenue gained by the Quest headsets weren't very ideal. But I think this is Mark Zuckerberg's attempt at like reducing the revenue loss that they've already experienced. Yeah. Sorry, it's a bit, my background is a bit noisy. Yeah, and then another thing is for Zuckerberg's management wise, actually just 2 days ago, Bill George actually ripped him apart because actually Zuckerberg has pushed out a lot of key members from his board, and these are actually people who are very experienced, and there's some consensus that he's kind of spiraling. So I think in terms of management wise, it's not the most ideal for him and his team, and I think people are very skeptical of how Meta will move forward from this as well, or like push back from the current financial losses that they've made. Yeah, and it is acknowledged that Zuckerberg's leadership on social issues and his costly push into the metaverse could potentially cause his company a lot of damage in the future as well. And then as for future outlook, I think our team has discussed that because many youngsters are moving away from Facebook, I mean, evidently from our generation onwards, I think a lot of people have stopped using Facebook already. And he's having a very ambitious and risky push into the metaverse. And he has actually mentioned that he's willing to lose billions in the coming years just to push forward his initiative in the metaverse, which may or may not reap certain returns. Yeah. And for our team's potential stock picks, it will be SIA and C Limited. Especially C Limited, I think, is a very good potential stock pick because actually C has actually recently acquired an Indonesian bank, BKI Bank. So they're actually gaining a piece of the pie in fintech in an area, in a market that they're pretty strong in, which is Indonesia. Like their presence, I think in Indonesia, there are a lot of underbanked people, which is why C has actually tried to gain some foothold in that for now. And I think at the current price that they are trading at, I think there is a lot of potential to make certain returns in the future. And our next team meeting will be on 17 September to firm up our next second stock pick. Yeah. So that's it for our presentation. Thank you.
Thank you so much. Anyone has any questions for this team? Yeah, okay, if there are no questions, then we can move on to team number 3. Okay, no change to the price target on Facebook. Yeah, so for the previous team, yeah, were you more disappointed on Meta's future, especially given that the updates that you guys gave, it does sound a bit worrying.
Honestly, I think sorry, Pauline. Sorry, continue.
Yeah, so any thoughts?
Honestly, right, I think it, like what Shinya says, I think it's definitely very, very disappointing. I think it wasn't the best stock pick. I think that to be very frank, I think the future outlook is kind of bleak because I think, I do think that I think Mark Zuckerberg is kind of spiraling. I think that they've sort of lost their way. There's not a very clear initiative as to where the company is heading towards. I think they're like all over the place in terms of like headsets, their VR, like nobody really knows what Facebook is trying to do essentially. And I think the stock could possibly continue dropping at this rate, and I think we need to pick other stocks to sort of balance it out, or we could think of sort of selling the stock essentially at our next meeting as well and pick other better stocks now. Yeah.
Okay. Yeah. If no one else has any other question, then we can proceed to team 3. Yeah, you can begin.
Okay, next, it's Dream Team, our August portfolio update. So here's a snapshot of our portfolio. The three holdings we have in the cash, our year-to-date return has gone down a bit from around 6% to 1.5% now. So the first company that we bought, Delco New Energy Corp. It's a leading high-grade polysilicon producer, and some key updates that we have since the previous update was the quarterly revenue recorded, which beat both revenue and earnings per share estimates by analysts. And it produced quite a significant amount of polysilicon, and more than 99% was the highest pricing in the market. And another thing to note was the improved revised guidance for the year, which is a good thing for us. And the third thing is that demand is still pretty solid, with products being sold out for August. So now what we have to be concerned about is the supply. So the concerns below here, we are concerned about the silicon powder price because the cost per kg has decreased from the high. And also management is seriously considering listing on the Hong Kong Stock Exchange. We are concerned about the implications of this. So for our outlook, we think there's some significant catalyst still there, so we recommend a hold, and we are aiming for a target price of 91. The second company that we bought, Adobe, is a leading software company that provides digital media and digital experience solutions for enterprises and individuals. So some key updates since the previous presentation. The shares moved lower together with all the other tech stocks, mainly because of their lower full year projection guidance. And also during the quarter, Adobe announced some price hikes for some of their subscriptions, citing the launch of new applications. But we noted that the hikes weren't very significant, so we don't expect a significant impact from this. And due to the strong demand of all the products in the Creative Cloud and Document Cloud and Experience Cloud, we saw that Adobe achieved the record revenue in the second quarter of the fiscal year. So we recommend a hold for this as well because of the strong earnings, and with all the new products coming in, we expect the user base to be expanding as well. But some risk we noted was some competitors who had some superior product lines for a few of the specialized Adobe products, and also the recession and inflationary pressure. And next, the third purchase that we made, GDS Holdings, the largest developer and operator of carrier-neutral data centers in China, and with their data centers primarily located in the country's economic hub. So some key updates since the previous presentation. We saw that total revenue grew by a significant amount, and EBITDA declined slightly. The net additional area committed was significant as well, and total area committed increased by more than 16%. And just looking at that is not enough. Total area utilized increased as well of over 22%, which is good news. And also we secured 3 new hyperscale orders in the recent quarter. But one thing to note was the decline revised guidance for the year of the revenue growth and lower adjusted EBITDA margin. So some concerns we have is the utilization of the existing data centers and the softer demand environment, as well as the rising COGS margin. For this GDS, our recommendation is a hold with a price target of 113 because we believe the tailwinds from the catalysts have not fully been realized yet. The lower energy prices and the expanding utilization rates of the existing facilities are still yet to be seen. But some risks that we are worried about is the concentration risk and new competitors coming into the market. Next, Jia will continue explaining on one share that we are still looking at, American Water Works.
Thanks, Sid. So American Water is an American public utility company that provides the water and wastewater services in the United States. So these are a few investment theses that we have come up with. It is currently the largest pure play regulated and water utility operator and positions itself as a preferred provider for the municipals. Its area of operations are also centered around the US regions with currently low water stress. And it is also a market leader in ESG initiatives. Next. We also think that American Water Works stays ahead of competition as it currently uses smart technology to improve its operations. So this will very much increase efficiency and also reduce costs. So some examples are its usage of drones and AI technology. Next. We also found some catalysts that this includes the aging water infrastructure in the US, which currently needs huge investments. So actually water breaks occur every 2 minutes in the US due to the current aging infrastructure. And there's a huge amount of investment needed to maintain. And we think that wastewater services will be of very huge demand over the next 20 years. And there's also seen to be consolidation in the fragmented water space. So the large operators like AWK over here are very much well positioned to make more acquisitions, and he has already made 7 acquisitions and are set to make more. So we think that these catalysts would be attractive for us to look at. Next. For ESG wise, we think American Water Works has displayed both in the ES and G sector. On the social side, it is affordable for customers, and this will translate to more local government acquisitions and also rate hike negotiation successes. And for the environmental part, it is also very dedicated to lowering emissions through their innovations. And lastly, there is exposure to different perspectives because 60% of the board directors are actually female, and they are also racially diverse. Next. In terms of financials, we think it is currently slow, but there is steady top line growth. There is around 5% of revenue growth every year and consistent operating income margins of around 34%. We're also very well aware of its consistent dividend growth. So this will provide us with a little more income as well, around 9% a year. And it is also highly sustainable considering that they have average payout ratio of around 54%. So there's still sufficient cash available for expansion as well as growth plans. And in terms of investing activities, there are significant outflow of cash for the current acquisition and as well as the capex. So they are well positioned to capitalize on the few catalysts that was mentioned earlier. And their current ratio is also improving by almost 20% a year. Next. Maybe C can share more.
To get a rough estimation of whether this share is worth buying, we use the dividend discount model because of the low consistent growth and the sustainable track record of increasing dividend payouts. So we just did a quick model and we arrived at around $180 worth of intrinsic value for this stock, which is a 21% upside from the current price. So we think this stock is worth looking a lot further into. And here are some of our assumptions and numbers. In comparison to peers, American Water Works still performs quite well compared to the industry median. We picked around 10 companies which were similar to American Water Works in terms of total enterprise value with EBITDA and debt to EBITDA. So overall, American Water Works has significant opportunity due to the macro environment as well as the stock rating by companies. Another company that we're looking into is SoFi, and the next update will have a lot more information on SoFi for you and what we think about it. So thank you.
Thank you.
Any questions?
Hey Sid. So yeah, thanks so much for the sharing. Sorry, is it okay if I ask a question about SoFi? Like even though you guys didn't present about it?
Yeah, sure.
I'm actually looking into SoFi myself. Maybe you could just kind of share like what is like the thesis for SoFi?
Okay, sure. Charlie, do you want to share that?
Actually, we're still currently looking at it. We haven't really go in depth, but we think it has a compelling business model because compared to like kind of like the traditional banks, SoFi actually has like a myriad of products and everything is like online and on the go, so it's very suited for like the younger generations like us. And also I think in terms of financial side, I think it's quite attractive right now because I think, if I'm not wrong, the book value is more than its price, so they have like 1/3 cash. So that's why we started to look more into it. And right now, because the tech stocks have tanked, so we think it's like at value to go inside, but we haven't really went in depth with the research yet. So I hope this helps.
I see. Yeah. Hey, thanks so much. Looking forward to the next month's portfolio update.
Thanks.
Thank you.
Any other questions? Okay, then maybe we can proceed to our last team.
Okay, yes, second. Are you able to see the document?
Yeah, we're able to see.
Okay, so first on our current portfolio update, because we got into Unity, it's currently down 55.9% since we entered it, but we note that it's been up 14% in August, and this is due to a couple of reasons, and one of it is that the company is looking to spin off its business in China for a potential $1 billion. And if we look at the second quarter of 2022, they had around 1.8 billion in cash equivalents, etc. So this will come in really handy because they are embarking on expensive expansion plans or R&D plans. And we also see that the operate segment, which is one of its significant business segments, was actually down 13% year on year. But on July 13, they announced their plans to merge with a company called Iron Source, which is a competitor to Unity in the ad monetization space, and is also an area where Unity has been struggling. So the company will be buying it's an all-stock deal, and the company will be buying back about, I think it was 2 billion in stock to offset the dilution of the all-equity transaction. And what this will do is that it will help Unity to recover well in its operate segment, as well as to boost its progress. And we do note that there has also been data issues that has impeded their performance, but the management has said that these data issues have been resolved. And so with these two in combination, we believe that there is room for growth, and we're curious to see where that will go. And we stand by what we said in the previous update, that they still have strong fundamentals. And so currently we're looking to hold Unity at the moment. Moving on to stocks that we are looking at, actually one of them is Daco, which was mentioned by the team just now. And as mentioned, they're a Chinese polysilicon manufacturer, and we are highly optimistic about their potential, and they are positioned between the global solar PV market, which has a 25% CAGR from 2021 to 2028. And if we look at some of their Q2 financials, their revenues and gross margins grew year on year quite significantly, as you can see. And there was also a 61% year-on-year increase in operating expenses, but this isn't really a concern because we see that the ratio of operating expenses to its growing revenues and gross profits has also significantly dropped. And if we examine their performance since around Q3 2021, they've been essentially debtless, and so this shows that the management is able to allocate their capital highly strategically even during the win. And we also see that they have a 80.3% fat free cash flow margin, and this shows that they have more than enough resources for its aggressive expansion plans, which would significantly boost their production ability as well as lower costs. And this leads me to my next point, which is that there has been a steady rise in production capacity and volume. As you can see, in Q2, it was 35% year on year. So it's well positioned to capitalize on the higher polysilicon prices. But some risks or issues that we might have would be that growth rate has slowed from 2021, and there is potential for the normalization through 2024 as the supply and supply chain catches up, and even the management has alluded to this. And there are also possible temporary headwinds to profitability if the Chinese government is seeking to curb the PV prices. However, we don't think that this will be too big of an issue because of their consistent increase in production output and capacity, and this would lead to around a double profitability even if there are normalized PV prices. But because of the recent optimism and all these good news, we think that it's trading at a relative high now, so we will observe it for a while more. But it's definitely a stock that we are watching closely. And next would be ISRG, which is Intuitive Surgical, and it's actually a stock that we presented for our very first stock pitch. So ISRG develops its robotic products that are designed to improve performance through minimally invasive surgery. And we believe that it's still a strong company with great fundamentals and balance sheet. However, we do have to note that it has tanked quite significantly since we last presented on it. And this has been due to a myriad of factors, and more recently due to the high inflation rates and people pulling back from these sort of stocks. And we believe that it still has strong fundamentals because it has a strong balance sheet, it has high recurring revenue. And I think one of the biggest compelling arguments is that it has a very sticky business model. But one point to note is that its client base is mainly comprised of hospitals because of the industry and products that they offer. And because of the headwinds surrounding supply chain, economic downturn, inflation, etc., this could also negatively affect its performance, and it might not grow to its desired level stock price before we hand the portfolio back. That's something to note, and why we will look at it more closely. But I think we're more optimistic on DACO at the moment than ISG, but we will update first. Thank you.
Thank you so much. Anyone has any questions for Team 4? Okay, if that's the case, I think we finished all of the teams already. Thank you so much for coming today. There are no updates from me. I think just take a look out for the upcoming September schedule that I'll be sending out for this month's events. Yeah, and sorry for having to postpone some last month's power update to today. Yeah, thank you so much, everyone. Take care. Bye-bye.